Good evening, traders and investors. Will back here with another one, coming to you with a Wednesday market recap. Hopefully all of you had a very nice day of trading today. And in today's markets, guys, well, the SPY and the QQQ putting in some big gains on the day off the back of some record profits from bank earnings and also a inflation report that came in a little bit better than expected in terms of the consumer price index. Now, this has led to one of the best days we've had since the month of November. Indeed, it is the best day in the markets we've had since the election candle when President Trump was elected into office, November the 5th for the SPY, and the QQ, same thing, guys. The best day we have seen since November the 6th, the day after the election. So it begs the question, is the pain now over for the markets during the January period, or are people getting a little bit too bullish, a little bit too early? We're going to take a look at that in today's video. So in today's video, as a matter of fact, we're going to cover a few things together. Number one, of course, we have to go over that inflation report in terms of CPI, analyze where the sticky points in inflation remain, and which sectors of inflation are actually performing quite nicely. Thereafter, we're going to take a look at a few bank earnings that I have prepared for you guys today, a very brief look into JP numbers, and a very brief look into Goldman Sachs. Now, obviously, there was a lot more than that today, but I picked the two best of the bunch. Goldman Sachs, arguably one of the best investment banks out there, and JP the de facto largest consumer bank in all of the United States. So we're going to take a look at those two corporate earnings, see how the banks are doing. Are they giving any indication whether or not the economy and the consumer is healthy? We'll have a look at that very shortly. Thereafter, of course, we're going to get into our technical analysis of our major sector rundowns, the SPY, the QQQs, and some of the minor sectors there as well. And thereafter, take a look at some of our big tech names, see whether or not it's a good opportunity to buy the dip with this renewed investor confidence today, or maybe is it patient to wait until more volatility catalysts have come past us. So that's going to be pretty much it for today's video. No portfolio update. The next one, as per usual, will be on the Friday session. So without further ado, guys, let's get into today's topics, shall we? So the SPY up a very healthy 1.82%, best day since early November, and the Q's up 2.3% as well. Now, in terms of the market breadth, today was definitely a beautiful change for once. Market was very broad all across the board, no major sector getting left behind as well, and all the interest rate sensitive sectors did have a little bit of a rally today because interest rates, the 10 and 20 year, were down significantly off of the back of a decent inflation report and those record bank earnings too. So we could be possibly seeing a peaking out of the interest rate cycle that we've currently been in right now in the 10 and 20 year yields, but we'll keep an eye on that. Usually to make those curl around for real, you have to give them a little bit more time. Big tech, obviously the largest outperformers of the day. Tesla up over 8% on the day, but all of big tech names having a very good time, and semiconductors as well. Semiconductors will be important to watch, especially tomorrow, because we get TSMC earnings before the open. And of course, I will be giving the earnings presentation on that tomorrow after the close. But semiconductors, great day. Financials, very good day. Everything was up significantly from the credit cards to the banks. All the major banks posting very good numbers. Take a look at the list down here across my shoulder. JP Morgan up 2, Bank of America up almost 3, Wells Fargo 6.69 after their earnings, Citigroup as well 6.5%, and BK 8% to the upside. So very healthy day for the banks. Healthcare, not too bad of a day there as well, and the bottom half fairly decent. In terms of the one-day relative, all major sectors were participating in the markets today, looking like a very nice day, led, of course, by financials off of those earnings. On the one-week relative, we have erased some of the damage, but not all. Basic materials, energy, financials to the leading, and technology, surprisingly, week over week, still negative, as is consumer defensive. So although the market continues to broaden out, the bulls still do have a lot of work to do. One day's worth of bounce, guys, is not going to be enough, and we know bounces have been nice, but can easily just be erased if ever we get some negative data or more negative sentiment in the markets. So we're going to take this one day at a time. It's up to the bulls to prove to us they want to recapture the daily uptrends and put an end to this weekly downtrending consolidation cycle. So before we take a look at more technical analysis, guys, let us dive into the CPI numbers first, and then we'll tackle earnings second. So CPI at a first glance, guys, was somewhat of a mixed number, but a decent number overall. Month over month came in at 0.4%. That is a rounding up to about 0.4 from the 0.3 expected. So that came in a little bit harder than expected. Year over year, however, 2.9, right in line with the expectation. Now, this is the fourth month in a row that inflation has been ticking up higher, or third month in a row, rather. So we have to take a look whether or not that trend is going to continue. Normal, though, that December is one of the hottest months just because of all the holiday shopping that occurs in terms of your core. Core was actually the bright point and why Wall Street loved this report so much. 3.2% down from the 3.3 estimate, which was also lower than last month, which came in at 3.3%. So all in all, guys, not a very bad inflation report, but you got to kind of dive in deep to understand these numbers. So let's do that right away. Now, here's your chart for inflation. As you can see, since September lows, 2.4, October was 2.6, November 2.7, and December 2.9. There is your 3 months in a row of hotter than expected inflation reads. That being said, guys, we are still kind of towards historical lows. 2.9 is not all that bad. We've hit those numbers before, not even in times of concerns where interest rates have been high either, right? July 2018, February 2017 was a little bit hot, and even prior to the pandemic starting, 2.5% in January. So I would not say that a 2.9 read is all that bad in the grand scheme when looking back on the last 20-25 years of data. Taking a look at the major indexes, major components of inflation that everybody looks to look at, take a look at food. Food is also relatively low in the scheme of its historical averages, right? 2.4%, 2.5%, a little bit of an uptick, yes, but still maintaining historical lows. Then we take a look at another good, apparel. Apparel also at 1.1%, also in line with historical averages. Where are the pain points though? Still is in shelter. Shelter peaked 8.2 in March of 2023. Now we have been coming down, guys, but it's been one of the slower ones, slower components of inflation to come down. We are now down, however, 4.6%. This has pretty much been a straight but slow line down. And take a look at this. Services has been the stickiest component of inflation. It includes shelter. However, take a look at services, still also on a downward trajectory. I know the bright yellow line is kind of bright, you know what I mean? But I can't really change the color. So you just have to kind of bear with it there. 4.4%, which is lower than November, lower than October as well. So services have been the stickiest component of inflation, as you can see from these charts, the only component remaining over the 4% range, but they have been coming steadily down. So at least that is good. Gasoline too. Gasoline has been coming up a little bit over the last couple of months, but still, guys, year over year, it is in deflationary territory, still down 3.4% year over year. Definitely not anywhere near the highs that we saw in 2021 and under the historical averages for the market overall in terms of that measure of inflation. So overall, guys, not that bad at all. And as I always do every single time, we're going to go over the where inflation is and isn't presented by Yahoo. And as we can see, guys, now most of all the major components of a normal basket of goods for the consumer are under the average rate of inflation. The most important part of this chart is household earnings, meaning your wages. Are your wages growing faster than the rate of inflation? If yes, then you are regaining purchasing power. I know it may not feel like it because groceries are still, objectively speaking, expensive. Things are more expensive than they were in 2020 and 2021, but that will always be the case. I always do this whenever we present inflation, guys. 2020, 2021, 2022, prices went up like this. Now we have normalized the pace of increases in pricing to this. That is the normal trajectory of inflation. We are never going to get these prices back, guys. If you want to get these prices back, just think of how much your parents paid for the price of their home back in the day, how much a bag of groceries was in the 1990s. It's normal that prices increase over time. That is by definition the result of inflation. However, what you want to avoid is a situation like this where you have runaway inflation. Now inflation is more under control. So although you will not probably ever get the prices we saw in 2020 and 21 again for your groceries, at least you are progressively earning purchasing power back in the form of rises in wages. Wages up 3.9% year over year, which is 1% above the rate of inflation at 2.9. This is very good. Now, the stickiest components, auto insurance, that's going to go away, guys. This was a repricing for a one-year event, pretty much. Auto insurance, still the leader in the category up there. Airfare still up 7 to 8% as well. Rent, 4.3, but is coming down. You would like to see these housing indicators right here below your average hourly earnings growth. That is what needs to happen. Those are still the stickiest components of inflation, as we saw when we measured the shelter cost graph right here. Now, moving on further down, a few other notable parts. Education now at 4. Restaurant meals, 3.6. Still a little bit high, but far off its peaks, right? You can even see the food away from home chart right here. It was a lot higher, this green line, and now we're kind of normalizing back down into the mid 3% range. So that is very nice as a whole, guys. Now, all the sectors that are below, take a look at this, guys. All the components that are below the overall rate of inflation, medical care, household energy, these are all very important things, right? Hotel rooms, college tuition, very important one for most people. Personal care, pets and pet care. This was a big one up here, and now it's all the way down there over the past year. Gasoline, transportation, alcohol, clothing, 1.2. Look at all of the ones that are now below year over year the Fed's target rate of 2%. Gasoline, transportation, alcohol, clothing, recreation, another big one for everybody, right? Prescription drugs. And now look at the goods that are in deflationary territory. These are actually cheaper than they were a year ago. New vehicles, furniture, used vehicles, groceries, that's a big one, guys. Groceries are actually down year over year. Appliances, electronics, these are all big components that people use every day. I know you don't buy appliances every day, but it just goes to show a lot of things are coming down. Electronics, a big component for people, toys, and rental cars. So there is your where inflation is and isn't. Hopefully I was able to express why the report was actually decent today and why we are heading in the right direction of inflation, despite what the last 1 month of headlines have been. I'll remind you guys, the last 1 month of headlines in terms of market declines and Jerome Powell being a little bit nervous about the inflation is all speculation inflation as to Trump and the possible tariffs that he's going to levy on other countries, and other countries, what are they going to do to retaliate? This is all speculation. What we are presenting here is the actual data for the US economy right now. So a lot of these declines being speculation, it's obviously normal that when you have a day that presents to you good data, the markets are going to pop because you remove a lot of that uncertainty. You're not removing any uncertainty from the speculation around Trump, but at least you're removing the uncertainty that we're starting off on a good foot for the year rather than on a bad foot with runaway target inflation in many, many sectors, right? So we'll see, of course, what happens with President Trump and his new administration, what he's going to do with the tariffs. But nice to see on a day like today, the markets are responding well to the current data that we have at hand. So that is everything that you have in store for inflation overall. Hopefully you guys enjoyed that. Now let's dive into some of the bank earnings and then we'll get into the technical analysis. So the bank earnings, guys, everything was amazing. Trust me, guys. Now take a look at JP Morgan right here. Look at the smash from JP Morgan. EPS beat by 17.5% and revenue beat by a very cool 2%, leading JP Morgan to have new all-time highs on their stock price. The stock now trading $252, looking quite fantastic in terms of the weekly uptrending expansion that they've been benefiting pretty much for the last 2 years of trade. So what are the highlights of the earnings? Well, I'm glad you guys asked because you know I have that prepared for you. So JP Morgan earns the biggest ever annual profit as investment bankers ride the rebound. And curious comments from JP Morgan CEO Jamie Dimon, as we'll take a look down further in the article. Investment banking fees jumped 49%. Trading revenue was up 21% for the bank as well. This investment banking fees, guys, we're going to talk a bit about this because it's very, very, very important. This is all about deal making. How much liquidity is available on the investment banking side of things? Are CEOs and are other corporations doing deals, mergers and acquisitions deals, IPOs, new market entrants, right? Big commercial deals. We want to know whether or not the big money is participating in this market. And you guys know it best, right? Big money only chooses to do deals and deals and deals when they have an optimistic view on the economy. You're not going to embark on a $1 to $2 billion condo project development or, any form of large scale development projects that could require billions of dollars in capital sourcing and funding if you have a negative view on the economy. So nice to see that the investment banking fees are up, but also when we take a look down there at the amount of deals that were made by the bank in terms of big money deals, that is where all of the, all of the attention should be, guys. That is telling you that the big money is optimistic as to 2025. You have to kind of read between the lines, but that is the moral of the story for these bank earnings. So the annual profit rose to a record as deal makers and traders reaped a windfall from rebounding markets in the fourth quarter. The largest U.S. bank also forecast its net interest income would rise above analysts' expectations this year, despite repeated warnings that high NII growth was unsustainable. And this was one of the things that we were going to pay most attention to, guys, is because the Federal Reserve tapered back its projections for interest rates, meaning we used to be able to, we used to think that we were going to get 4 interest rate cuts this year and have a final annualized rate for interest rates at 3.4 by the end of the year. Well, the Federal Reserve back in December said, no, you guys are only getting 2 cuts. We're going to be at 3.9 by the end of the year. So we were kind of nervous a little bit. Well, not nervous, but we were curious to know whether or not JP Morgan and other banks were going to reduce their net interest income guidance for the year. Very normal, right? If interest rates stay higher for longer, the demand for loans from consumers towards banks are not going to be as high as they would if interest rates are lower. That being said, JP Morgan did not see it was a problem, actually increasing their guidance for net interest income for the year. Now, JP Morgan's strong results bode well for the banking sector, which is seeing a revival in deal-making and fundraising activities as the U.S. Fed cuts interest rates to bolster the economy. The U.S. economy has been resilient, said Jamie Dimon, the CEO, citing low unemployment and healthy consumer spending. He is not wrong. We saw the jobs reports last week, guys. The JOLTS jobs openings reports, the non-farm payrolls showed that the economy was by large at full employment, with the unemployment rate at 4.1% and healthy consumer spending as well. This has been true, guys, as measured by overall retail sales and additionally through measures such as GDP. Consumer spending has been doing very well. Now, here's what he continued saying. Businesses are more optimistic about the economy, and they are encouraged by expectations for a more pro-growth agenda and improved collaboration between government and businesses, talking about Trump coming in and possibly making it easier for businesses to operate through possible tax cuts and possibly deregulation of several sectors. Still, he cited risks. Government spending is one. This will be addressed by Elon Musk and Vivek Ramaswamy through the form of Doge, of course, inflation, which has been an ongoing concern, and geopolitical tension. So Jamie Dimon recognizing that there are still a few overhanging risks to these markets and to the U.S. economy as a whole, but they are not front and center as much as they were last year. So moving on further, NII boost. The bank sees NII, net interest income, of $94 billion for 2025, higher than the $91 billion estimate. So there's your beat on net interest income. And moving on further, loan growth has been muted despite market and industry optimism. And while the credit card business is expected to grow, the pace will be slower than last year. So as you can see, guys, interest rates do have an impact on the consumer at the end of the day, as the loan demand is not as strong as it would have otherwise been if rates were not this high. JP Morgan, which has been rapidly expanding its workforce, expects headcount to be flat in 2025. It has more than 317,000 employees, highest amongst its peers. This is another thing we were looking out for, guys. Is the bank going to be laying off people or not? And the answer is no. Now, you can bring up last week's article where JP Morgan was saying that they require all employees in 2025 to return to work at the office. Who has done this before? Amazon, and who has done it as well? Meta, as of most recently. This is a soft form of layoffs by forcing people back to work from a work from home schedule. They know that a lot of people will just refuse to do so and quit. So it's kind of a form of soft layoffs, but at least the bank isn't laying off people by the tens of thousands in order to protect their profits. Now, moving on further, the financial industry may benefit from President Donald Trump's return to the White House, as his administration is expected to tap regulators who could ease capital rules and merger approval. So looking to do more deals in 2025. Fantastic earnings from JP Morgan, guys. Nothing bad to say. You would be hard pressed to pick apart anything from this earnings report. And when we take a look at the liquidity ratios for the bank, is the bank well capitalized, or are we going into 2008? Not even close, guys. Not even close by a landslide. So here are your capital equity requirements for the bank. 15.7%. I will remind you of the actual baseline for capital requirements set forth after 2008 to avoid another financial crisis. The minimum is 8%. 6% of which has to be Common Equity Tier 1. That is your CET ratio, a very common used ratio. I will forego the explanation, but all you need to know is the bank has more than double, arguably almost triple, the average requirement for liquidity capacity. Looking very strong is JP Morgan in that respect. Average loans were up 2% year over year, 1% quarter over quarter, and the average deposits were also up 2% year over year. Debit and credit card sales volumes up 8%, active mobile customers up 7% for their consumer banking division. Overall, book value per share rose to 116.07, up 11%. So building that balance sheet, and here's your record, guys, 50% increase in net profits in a year's worth of time. 14 billion of profits versus the 9.3 in the fourth quarter of 2023. Looking excessively strong, guys. And if you're asking, is the consumer over leveraged on credit? This is a concern that I read far too often in the markets over the last 3-4 months. The answer is no, guys. Here's your provision for credit losses for consumer and community banking. You can see it is down from the third quarter of 2024, elevated from the fourth quarter of 2023, but that is only because they have acquired more customers, and more customers have gone with credit cards, of course. So this increase has been proportional to the amount of people that are on their network, essentially, right? So although this is an uptick, it is down from third quarter of 2024. That does not show you that the bank is nervous. If not, they would be increasing the provision for credit losses a lot more than they are right now. And here is your commercial and investment grade bank clients, right? So are the commercial real estate loans a problem? Are people defaulting by the tens of thousands, leading to trillions of dollars in possible losses for commercial real estate? No, not really. Look how much money they set aside for that this quarter. $61 billion, a lot lower than it was in third quarter of 2024, and a lot lower than it was in the fourth quarter of 2023, after we had a banking quote-unquote crisis in March of 2023, when you had a few banks like Silicon Valley Bank go underwater. So all in all, guys, I mean, you would be very, 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 very hard-pressed to pick apart this report. Here is, again, from your consumer and community banking, from their earnings report directly, the net charge-off rate, 3.3%, arguably similar to what it was last quarter, a little bit higher than fourth quarter 2023, but it's perfectly within the average historical norms of the bank. And the net charge-off recovery rate right here for commercial clients this time, commercial investment bank, is a very cool 0.25%. We do not see any massive expansion there. So the bank, number one, is very well capitalized, record profits, very solid balance sheet, no possible 2008 financial crisis. And in terms of the consumer, we went over all the ratios. The consumer is sitting quite fine with the level of debt that they have right now on revolving credit cards, and also measured by their loans. Are they defaulting on mortgages or auto loans? No, because those are also included in your consumer and community banking rates down there, right? So not too bad at all of a report for JP Morgan. Excessively strong, shows the banking sector is indeed resilient. And as currently at the valuation right now for 2025, JP Morgan 17.51, is the EPS for 2025. 14.27 is the forward PE. So even though the historical average is 11.61, is this extremely overvalued? No, but is JP Morgan a buy up here? It's very debatable. Usually I like buying JP Morgan on dips more than nothing. At the all-time highs right now, you can argue it's not the worst deal in the market, but it's also not an attractive opportunity. So for me, JP Morgan is a pass. Unfortunately, if you have shares that you've acquired over the years from here, I do not see any reason to sell, but starting a position up here, guys, may just be a little bit risk. And that is my thoughts on JP Morgan. So that is number one. And now let's take a look at Goldman Sachs to see the other side, right? So JP Morgan's a consumer-facing bank and commercial-facing bank. Goldman Sachs is only an investment bank, right? They tried to pierce into the commercial and consumer banking division over the last few years, and they had to shut that down last year because it wasn't going so well. So they're sticking to what they know best, which is investment banking. And investment banking, they did very well this quarter. Take a look, guys. Beat on EPS. This is a substantial beat, guys. 45% beat on EPS. That is absolutely ridiculous. And revenue beat by 12%. These are banks, guys. It's not Palantir, right? Fantastic, fantastic numbers from Goldman Sachs. You'd be hard pressed to pick apart the report. We're not going to go as deep as with JP Morgan. JP Morgan's important because we have to take a look at what the consumer is doing in that bank, right? Or how the consumer is positioned with that bank. And they were positioned quite well. Now we get to see, what is the big money doing? Are they doing more mergers and acquisitions? Are they doing more deals? Are they doing more commercial deals? Are they doing more IPOs? And the answer is wildly yes. Goldman shares rise after topping estimates on strong trading results. So there you go, guys. The bank said profit roughly doubled from a year ago to 4.1 billion as revenue grew while expenses shrank. Revenue jumped 23%, helped by higher equities and fixed income trading revenue and rising investment banking results. Extremely, extremely strong, guys. I mean, every single division, whether it was equities or fixed income or derivatives, investment banking fees, also did very strong. Now, the another source of strength for the bank was its asset and wealth management division, which saw revenue jump 8%. So large, high net worth clients are now participating more and more in the market, having their money managed by Goldman Sachs. That is very good. It shows you that the big money is optimistic about the economy as well. They are deploying billions, guys, not just you and I's $100 DCA per week per paycheck into the markets or something like that, right? These guys are deploying billions, and they will only do that if they think that the next at least 2, 3, 4 years of the economy will be strong. Because a lot of these guys have been sitting on the sidelines since 2022, and now we've seen over the last few quarters that I've been covering these earnings for you guys on the banks, they're now starting to participate back in the markets very well. Now, with an improving operating backdrop, talking about the economy and Goldman Sachs' own backdrop, and growing CEO confidence, this is key. Absolutely key for the analysis for big money. We are harnessing the power of One Goldman Sachs to continue to serve our clients with excellence and create further value for shareholders, said David Solomon, the CEO. They've been riding a wave of enthusiasm over a rebound in Wall Street deals. Now, the Federal Reserve's easing cycle and the November election from Donald Trump boosted expectations for mergers and stock deals. So, for Solomon, the setup couldn't be more different than a year earlier in the aftermath of a strategic pivot away from an ill-fated foray into consumer finance. So guys, Goldman Sachs, you saw it right there, doing more deals, more big money is coming to the table to do deals of all types and sorts. And also in terms of the asset management and wealth division, people are putting more money into the markets, putting more money to be managed by Goldman Sachs. All very good things for the banking sector. So those are your banking sector results. I did not do the valuation for Goldman Sachs, but essentially this one is trading a little bit rich, kind of like JP Morgan as well. Monthly overbought conditions. For me personally, guys, I don't really buy the investment banks, Goldman Sachs and Morgan Stanley. There's nothing wrong with them. It's just not a trade that I participate in that much, although they have grown excessively nicely over time. Same concept as the rest, right? You usually just want to look at the 12 and 26 EMA and make sure you are in a weekly uptrend. Usually a good proposition if you're trading to start buying these around the 12 or between the 12 and the 26 EMA when they try and set the monthly higher lows as they have been. Right now, though, a little bit too far extended from the 12 EMA in my humble opinion. After that, you can have some pullbacks into the 12. This is 2022, of course, so different market, but it's run a lot, right? So probably not the best proposition to be buying Goldman Sachs up here, but all in all, very happy with the overall bank's performance and very happy with the overall inflation report. And that concludes the slight foray into the bank earnings. I'll be giving you more tomorrow. Tomorrow, we're going to probably look at Bank of America, TSMC earnings as well, and maybe even dive into UNH earnings, although there will be some uncertainty there with the Donald Trump policies moving forward. So that is pretty much your recap for that. Now let's dive into the good stuff, the technical analysis, shall we? So if we're taking a look at the SPY right here, guys, in terms of the TA, well, arguably not much has changed. I know I say that a lot, but it's true. Not much has changed indeed. We are still overall, I mean, I very rarely put the trends or the trending channels on the chart just because I think that price action can do arguably the same job. As you can see, we're still in the downtrending channel, reacting nicely from support over the last few days, but we are arguably still in this daily downtrend, approaching the peak of the cycle, and we have left a little bit of a gap behind us right now. Even though the hourly time frame is up, we do have a pretty massive gap down below here, so you want to pay special attention to 589.50. If you flush this to the downside, the bounce is over, and then the bulls will be looking to seek a higher low, to reset into a possible daily uptrend. It's a good thing that we got well back above this area of support because now we can fall back, use it as support, and go for the daily trend change. We have had our fair share of bounces in the market since Jerome Powell. They have all resulted, unfortunately, into lower lows. So maybe after 1, 2, 3, maybe third time's a charm, and we can get the daily higher lows and daily uptrend conversions. But as of right now, we will take this one day at a time on the SPY. We will only get the actual follow through, guys, if the market breadth continues improving. And let's take a look at that, shall we? So fear and greed, we are still at a fear read, even after today's beautiful rally. Market momentum, still extreme fear. Net new highs and lows on the New York Stock Exchange. Little bit of an uptick right here, but you can see we are still at some of the lowest points that we've had over the last year. And stock price breadth, even though it has been improving, is still arguably as well some of the lowest points that we've ever seen over the course of the last year of trading. So all in all, momentum is coming back a little bit after this 1 days of bounce. Percentage of stocks above their 20-day moving average, we are now back above 50% after spending a few weeks down here in the low 20s and I was saying that it was a good opportunity to start buying the dips slowly. Indeed, it was. We are now back within the average range of 50% of all stocks above their 20-day. So the market is broadening out in a slow fashion, but is indeed broadening out. Percentage of stocks above their 50-day. You can see that the recovery here is a little bit slower, of course. Obviously, the faster term moving averages after a big bounce will have a better chance of recovering the percentage levels very quickly. These longer dated ones take a little bit more time, of course, right? Percentage of stocks above their 50-day, we are still relatively at low reads of 37, arguably some of the lowest that we've had in the last 2 years of trade. So although it can go lower a little bit, we are still in a buy the dip territory, as well as having a lot of fear catalysts. Everything points to the fact that it is a buy the dip opportunity in the markets right now. On the percentage of stocks above their 200-day as well, we had a nice little rebound out of the lower 50 percentile range. We are now at 52 off of the bottom of 44, arguably some of the lowest points that we've achieved all throughout 2024 were in August with a Japanese carry trade unwind, and then just last week when we had the rest of the market falling off a cliff into the early stages of the January effect. So the markets are coming back slowly, but as I said, guys, the job's not done. Need to reset the daily uptrend, and only then will you have the confirmation that this weekly downtrend is possibly finished, and we may just be looking to recapture the weekly uptrend as well. So we'll keep it posted, guys. What's fun about these markets now is that I was saying that after Jerome Powell, there was a ton of volatility catalysts in the month of January. We've been removing those uncertainty and volatility catalysts one after the next. Last week, we removed some uncertainty around jobs. Jobs openings were good. Non-farm payrolls were good. Those are done for the month. This week was PPI and CPI as well, both showing that inflation, although on a bumpy path back down to 2%, are still largely in control. So now we have that volatility catalyst removed, and now we have a whole sector's worth of bank earnings, which shows that the economy is strong. Deal making across investment banking, mergers and acquisitions, and etc. are going higher too, and the consumer is on very strong footing, not with too much debt that they cannot handle. And from inflation as well, we also have noticed that the earnings ratio is above the overall rate of inflation, so consumers are slowly regaining that purchasing power that we've lost over the last 2.5 years. So all of these volatility catalysts, one after the other, are being removed. And when they all have favorable outcomes in terms of the data, well, that is when the market starts repricing. Maybe we're not doing as bad as people were anticipating. So always a good opportunity, guys, to buy the dip when several things are lining up. The fear, the uncertainty, the doubt was just that. I'm not saying we're out of the woods just yet, but even if we do dip a little bit lower, I will be buying the dips on my favorite companies and possibly even some of the indexes too. Moving on further, guys, taking a look at the Qs. Qs, same concept, right? Downtrending channel is clear as day. Daily downtrend, 1 day's worth of bounce is nice. You can argue that yesterday was also a bounce day. We are bouncing nicely. Hopefully after 1, 2, maybe third time is a charm. We're slightly back above this overhead, used to be resistance area, 514 down to about 510. Let's see if we can actually use this as support and reset to a daily uptrend and break through this descending channel. All in all, the Qs are not looking too bad. We are still in the context of a weekly downtrend. And I was saying, usually when you hit the 26, anywhere between the 26 and the 50 EMA, usually a decent time to be buying the dip. And hopefully you guys were able to use historical data to kind of show that it was a good opportunity. So hopefully, as I was saying, you had a lot of buying power the past few weeks. And maybe this week you started deploying a little bit of that as we hit some of the lower levels. So looking not too bad on that front, but still a lot of work for the bulls to do. The bounces are very nice, guys. We've had nice bounces, 78% bounce again, 618 bounce again. Similar to what we had the last 2 times, but now we need the bulls to convert this daily uptrend, put an end to this weekly consolidation, take out the weekly lower highs, and then maybe move on to the reset process of a weekly uptrend into February. That would kind of support the seasonality. January is slightly awkward as a month. February, we can see some further gains, but the market really starts lifting off in the early portion of spring. So moving on to financials right now. Well, financials, of course, the best sector of the day by those banking earnings, and financials has finally done one of the 2 scenarios that I was talking about, right? So this scenario is the best case scenario for the bulls. Engulfing move. Yes, we have left a gap behind us, but now the bulls have created a ton of space off the lows, 47, to be able to reset into a higher low for a daily uptrend shift. So even if we lose a bit of ground right here and start retesting, just understand these guys are now going to be acting as support roughly around 48.50, and the bulls have all the space in the world to reset this into a daily uptrend. If they can successfully do that, suffice to say the weekly downtrend will be finished. Nice weekly engulfing move right now, and now it's up to them to reset into the new weekly uptrend. 26 EMA was almost tested, and in the context of the last 2 years of trade, usually has been a good buying opportunity for some financial names out there. I was personally waiting for the results of earnings because they arguably could have been interpreted either way if they were bad. But after this, I think it's clear as day, black on white, guys, right? The bank earnings were very good. So now any dips, in my humble opinion, are going to be possibly for buying opportunities or possibly writing some short puts on your favorite banks in the market. Financials not looking too bad. Now moving into healthcare. Healthcare still remains a slightly weak sector, but tomorrow could get a little bit of a boost depending on the direction of the United Health earnings, of course. United Health, one of the biggest names in all of healthcare, especially the biggest issuer in terms of healthcare plans and others. So be curious to see their earnings tomorrow. We'll cover them on the channel. Now, in terms of this, daily uptrend is clear as day, trying to set the higher lows, trying to maintain the daily uptrend. But as of right now, guys, the context is still this massive weekly downtrend. The bounce so far on the weekly 4 weeks worth of bounce has been okay. A 50% retracement gives the bulls 50% odds of resetting the weekly into an uptrend and 50% of unfortunately just unraveling and retesting the lows. Tough to tell until we see Trump's policies on healthcare, and also tough to say until we see these healthcare companies' guidance for 2025. So in terms of that, healthcare still remains a little bit of a mixed bag, but as I was saying, my favorite two names in the sector right now, arguably for a little bit of a swing trade, Johnson & Johnson, entry is here, stop loss goes below the lows because that invalidates 2 years worth of support, and the take profit is up here, and TMO, arguably the same concept worth of a trade, even though we're up today, you know, the trade was in the past few days. If you get a little bit of a retest down here, decent little entry, stop goes below there, and we are targeting the highs. These are two names that arguably do not stand to be affected so much by Trump's incoming policies. Moving into semiconductors now, and they actually had a very decent day, but it was not enough to change any form of trend whatsoever, guys. So 2.35 to the upside, led mostly to the upside by some of the biggest components in semiconductors. Take a look, NVIDIA was one of the best names on the day, really needed it as the whole sector was kind of weak lately. But as a whole, guys, we're still trapped, right? Overhead resistance 260 down to 250, and below support 232 down to 218. So all in all, slight trendless action on semiconductors. As I've always said, if you really want to see this sector break out, you need to close a weekly candle above 260. Close a weekly candle above 260. You can then use 260 as support for the retest and then run. Only then will you see semiconductors start to come alive, but not looking too bad, guys. We're waiting for that MACD cross, and the guidance that we've received so far last quarter hinted towards the sector as a whole being able to expand into 2025. That's what everybody was saying. Let's hope TSMC reiterates the exact same thing they said last quarterly earnings when we said it on the channel. They said that 2025 was going to be one of their best years ever. So let's see. Are they going to be able to reiterate that guidance in tomorrow morning's earnings? Moving on to IWM right now. So the Russell benefiting from the decrease in yields today, right? We're going to take a look at yields a bit later, but obviously when yields come down a lot and you have broad market performance like this, namely financials, I will remind you, financials is a very large component in the Russell, 17%, industrial 16, healthcare 16. So when all three sectors of the major Russell components are up on the day, namely banks, well, the Russell is going to get some lift. That being said, the context was a daily downtrend, hit the 200 daily moving average here at 215, bounced out of the support area that we had designated 216 down to 208, and now engulfing move by the bulls. The only problem is, where have we engulfed into? Unfortunately, a slight area of resistance, 231 down to about 225. The prior all-time highs there, a little bit of peaks over here as well. So curious to see, can the bulls recapture this level right away, or maybe do they have to do the two-step process of recovery? One thing's for sure, they've created a ton of space off the lows 214. So now it's up to them to reset into the new daily uptrends. We have, of course, left a few gaps behind us over the last day of trade. The big one is right here. So if you lose the hourly time frame into tomorrow for hourly consolidation, that is the end of your daily bounce, and you look to reset higher low into higher high, get the daily uptrend back, and as a result, you would put an end to this weekly downtrending cycle by putting in an engulfing move on the weekly, resetting the weekly as well. So the Russell not looking too poor, but I'm still a fan of taking this trade down here if we continue to unravel, because we know still a few volatility catalysts on the horizon. Next week, we have Donald Trump, the inauguration on the Monday session. And thereafter, guys, we start the big tech earnings landscape too. And at the end of the month, we possibly get a pause from the Federal Reserve on January 29th. Lastly, looking into the Dow Jones, similar to the Russell, engulfing move by the bulls, looking very, very, very strong in that respect. Daily downtrend, now we get the engulfing move. The bulls have a lot of space, but we do still have a quite nasty gap here. So in the event we kind of give some of this back, hourly downtrend into daily consolidation, doesn't really matter at this point. A lot of space. 41,800 is the lows. We are looking for a new daily higher low for further trend continuation. And the good thing with the Dow Jones is that we reacted nicely to the support zone, 42.5 down to about 41.9. We can then now use this as below support for us, reset the higher lows, possibly go for the daily trend change, put an end to this weekly consolidation. That will be our weekly lows. Looking good. This was a weekly downtrend. We now have one big leg of engulfing move. Now it's up to the bulls to recapture the weekly uptrend, which we hadn't lost. This is the first downtrend since the fall of 2023. So will they be able to recapture it in one clean shot, or will they have to do something like this? Engulf and then do the long two-step process of all-time high expansion. We'll take a look, but all in all, very healthy bounce. The bulls have created a lot of space across everything, right? Across the SPY, a lot of space. Across the QQQ, a lot of space. XLF, a ton of space. Engulfing move. Healthcare, not so much. Semiconductors, decent amount of space, but into resistance. IWM, decent space. And the Dow Jones. So, all right, similar to a few times so far, a lot of space has been created. Now, can we convert that into daily uptrends? That is what we'll take a look at over the next coming days. But the Dow Jones, look at the daily MACD. After being weak since the early portion of December, MACD on the daily finally getting across. So could be looking for possible more momentum into the end of the month. But obviously, guys, a lot of factors between us and the end of the month. So we will take this one day at a time, as I always say on the channel. Moving into yields now. Yields with a big engulfing candle to the downside. This is exactly what you want to see when you're looking for local tops, right? That being said, the daily uptrend was clear as day. Higher low, what we need to see is more of an engulfing move. Take back more and more of this, and then you will ruin the bulls' momentum. You can set up for a lower high into lower low, and only then will you start putting in some weekly slides on the 10 and 20-year yield. Nice little day of action, guys, but I would not say that after only one day, the concern for higher rates for longer is going to go away. So we will see over the next few days, how does this chart play out? Do we engulf more to the downside and give the bears on the yields, aka the bulls on bonds, the opportunity to reset into a daily uptrend? Here's your TLT trade, right? I had the fibs out there, but I'll do it again. So 1 day's worth of bounce, very nice. Put the fibs on there. It is a 618 bounce. However, we've left a big gap. We are looking for a new higher low for daily uptrend. That is the inverse of the 20-year. We're looking for more of a move, lower high into lower low. This is what you want to see for the rollover on the longer term yields, the peaking of the yield cycle, which is very close to October and fall of 2023. And the US 10-year as well, very close to the peaks of 2023. So TLT, this is your trend change attempt, guys. The bounce is nice, but so far it's only a bounce. What you need to see is higher lows for higher highs. There is a trade opportunity here. The trade is as follows. If we recapture a bit of lows tomorrow and go for a little bit of this gap fill here, right? We're waiting for the daily uptrend. The entry goes here, the stop loss goes there, and then you start targeting the highs and the recaptures of the $90 levels. And that is if you're a conservative bull. If you're an aggressive bull, then any dip that goes down below, you're going to take the trade here, put the stop loss there, and go for the expansion. There is a trade to be made here, but please do not forget, guys, put some decent time on the contracts if you're going for calls on these. I myself was eyeing these, and I'm not eyeing any sooner than January of 2026 for this type of trade. Can use TMF, can use TLT, whatever your preference is, guys. We're trying to find a bottoming area. We're not trying to time the actual bottom. We're trying to time a range of a topping out process on the yields as a whole and a bottoming out process on bonds as a whole, as we've seen a few times in the past. That's everything for yields. Taking a look at Bitcoin, give me a very brief moment. Try to keep this one under an hour as much as I can, but we had earnings, of course, and inflation to discuss, right? So Bitcoin down about 0.6. Well, the Bitcoin was actually up today. This is the new candle that started at 8 p.m. Eastern. So Bitcoin as a whole, guys, rejecting from resistance 101 down to about 97. It did crack above 100K briefly today. What the bulls want truly is to be able to set a new higher low for a trend change attempt. As of right now, getting rejected, but a very beautiful bounce off the lows. If we start retesting to the downside, guys, I will once again be playing short puts under the market at these levels and maybe even buying a little bit of Bitcoin if we do come down here again. That being said, the daily is not looking too bad, and the weekly is still just kind of trapped in some form of a tightening range, similar to a tightening range that we had back here. I'm not going to say it's going to last this long, but it's the same concept, right? It's just a tightening range at the higher end of the move, which is quite bullish, holding on to this 91 down to about 88K, holding on to the 12 EMA as well, and just consolidating somewhat sideways on the monthly before possibly putting in a new expansionary move when the risk on trade becomes more prevalent. But as a whole, guys, Bitcoin and all of crypto having some very nice bounces today. Ethereum as well. Daily downtrend now putting in the engulfing move, but the bulls, that is only step one. Now we need step two, daily uptrend conversion. When you get the daily uptrend, you know the weekly lows are set, and then you have to do the same thing on the weekly time frames. Put in a nice size bounce, reset the weekly uptrend, and have it look something like this. So Ethereum coming nicely out of the lows right here, 32 to about 3K. I was playing Ethereum in the trading account using short puts on ETHU, this ticker right here, writing short puts under the market, well under the market, and those performed quite well. All in all, crypto is not looking bad at all today, but today, similar to the rest of the landscape that we've had, at least over the last month, Bitcoin dominance just not going down. When you want to see the altcoins start really outperforming, you need to see a weekly downtrend confirmation. That will only happen at this point if you get a break of 56% to the downside, weekly downtrend confirmation, possible monthly slide on Bitcoin dominance. That is when you'll really start seeing the altcoins come alive. But as of right now, Bitcoin still remains the top trade of the bunch. Now moving into Apple, shall we? So big tech, decent little bounce today on Apple, guys. And there's also a trade available on Apple right now too, coming out of oversold conditions. I did not want to play Apple into CPI nor into bank earnings. But now that we've removed a lot of fear catalysts from the market from those two very big things, right? There is a possibility to possibly play Apple at this current time. I'll remind you on the weekly, very nice weekly uptrend. This is a breakout retest. Where did we break out from? The prior all-time highs. Where are we retesting? The all-time highs as support this time, right? 26 EMA has also been grazed. So if you're a more aggressive bull, even though we are in a daily downtrend cycle right now, technically speaking, right, if you want to be extremely on point with the strategy, you would need to wait for daily uptrend confirmation. The entry is here, stop loss goes there, and you're targeting the previous all-time highs, of course, over the course of the month of February and January. If you are a more aggressive bull and you want to call the bottom with the size of this bounce, well, the entry is pretty much here. The stop has to go below there because if not, if it rolls over, guys, we're heading to the lower level, 225 down to 218, maybe touching the 200-day EMA at around the 220 mark. So Apple looking pretty good on the weekly time frame. The stock was down top to bottom over 11%. And we take a look at this yesterday. When Apple is down 10 to 15% from local highs, usually it's not that bad of a proposition to be entering some form of swing trades on the stock. I'm not saying, remortgage your house and buy Apple calls with it, but there is a case in point for playing a little bit of Apple right now. Despite the high valuation, you could have a decent little bounce heading into earnings, which is going to be 30th of January. So Apple, not looking bad overall, guys. Now let's take a look at AMD, shall we? So in terms of AMD, guys, of course, they were up today, 3.3% with the rest of the sector. But all in all, AMD still has a lot of work ahead of them too. So that being said, we are in the context right now of the daily flush. They had the daily uptrend. Now we have flushed, found a somewhat of a local bottom around the support range, which was roughly 115 down to about 98. 200 weekly moving average was a big one to watch out for. Last time it crossed, it was the bear market of 2022. Other than that, though, it's held up the 200 weekly EMA quite well, which is why I was saying this area is definitely a buying opportunity if you agree with the thesis for AMD. And the thesis is a quite simple one. The valuation is very cheap for the amount of growth that they will be having. 2025 should be their best year as they are ramping up the data center business. You can see that from the expansion in their gross and net margins, but also their guidance towards expansion of EPS, the best they've ever had in company history, and the best revenue expansion they've ever had in company history as well. So the risk to reward profile is favorable for AMD down here, but I'm not saying there's not any risk on the company as a whole. There definitely is. It's just I think the reward outweighs the risk if you have at least a, let's call it 6 to 12 to 18 month timeline, right? I'm not calling for the massive rally like this. It will take some time, but I think the valuation down here is indeed quite fair. Now we are embarking on a little bit of a bounce, but you guys know the rules, right? Need to have a more sizable bounce than this because the bounce size is not very good right now, not even a 30% bounce. So the bulls need to do a little bit more work, pull us up into the resistance range, right? And give us a new daily uptrend similar to what we had right there. That is the only time that you can say that weekly lows are being set, is if you recapture the daily uptrend, weekly lows will be set. Then we look to do the same thing against this weekly downtrend. Need to put in a sizable bounce, reset the weekly uptrend. So a lot of work to be done for the bulls, but I am looking to buy more of the dip on AMD. As a matter of fact, early on in the day, I did write a position on AMD, the 115 puts for about 2 weeks worth of time, and I got about $2. So my break even on those is 113. I'll continue to average into the position if we drop a little bit lower. Moving on to Amazon right now. Amazon looking quite good, 2.5 to the upside. As a whole, guys, still a downtrending channel as well, similar to the SPY and the QQQs, but a nice little bounce, right? So we'll see, can the bulls eventually set up for a new daily uptrend shift? That is really what we're looking for in Amazon's price action. They've been slowly fading down into this range, guys, but for all intents and purposes, it is a bull flag. Even if it is a weekly downtrend right now, very shallow declines on Amazon in relation to the size of the move to the upside. If there was really some concerns over Amazon in the last 1 month of trading, they would be down a lot more, right? So suffice to say, Amazon is holding up very well, arguably retesting very close to the 12 EMA as they've done in the past, which has been a decent area to slightly buy the dip. We were calling that the buy the dip area was 214 down to about 207, a little bit more of an aggressive area. The more conservative area, of course, is down here to the 200 level, which is roughly the 26 EMA, usually in the context of an overall bull market. When Amazon makes its way to the 26 EMA, it's a good time to start buying. You can see it does dip lower sometimes, of course, but it is a good opportunity to start buying the stock if it's a company that you like very well. So Amazon looking very good, need the daily uptrend shift, but all in all, not looking too bad. I will possibly be looking over the next few weeks to write some short puts into earnings below in this area here. Now that we have some more confirmation on inflation, more confirmation from the banks in terms of the health of the consumer, I am willing to play Amazon a little bit more aggressively, but not so aggressively, right? Short puts down here is going to be the recipe for me. Moving on to Google right now, 3.10% to the upside, and Google retesting arguably some of its all-time highs close to the 200s. Google pretty much trendless, right? Just a sideways range for the last month of trade, but protecting the lows down here, 191 to 188. We will be looking, can they expand into the new daily uptrend and break and close above 200, something they have not been able to do. In terms of the weekly is not looking too bad either, just somewhat of a tightening range. For the weekly trend expansion, I'll remind you, you do need a break and close on the weekly above 201. We will see, can they get that done this week? Or maybe might they be muted into their earnings, which is Tuesday, the 5th of February. In terms of Google, I'm still a fan of playing it in the mid 180 range. So for every which reason we retest the lower end of this, and I can find some short put opportunities, 185 or better, I will probably be taking Google there. And you guys know if we come down into the 180s, I will be resetting for some bleep calls on Google as well. All in all, the stock is looking very good, and the valuation for Google is looking even better at 1.43 peg at around the 196 mark. The company is very, very cheap. Moving on to Meta right now. So Meta also having a decent day, 3.85% to the upside after TikTok might be banned on Sunday. And Meta might be one of the companies that could be offering to buy it. Elon Musk has obviously been in the discussion as of recently, but that's all speculation. We'll see what happens. But fairly good today, 3.85% to the upside. Still no new highs though. 628 is the mark to break that for the new daily uptrend and also for the expansion of the weekly time frame as well. It's all about that break of 632, but Meta is looking very strong here, guys. It is currently at the current time recently trying to go for the weekly uptrend, but if for whatever reason, guys, because there's always a case, if we roll over, probably coming down to the, let's call it 550 to 530 range, which would be my ideal location to add a little bit more Meta. In my opinion, guys, Meta's going to have probably a very good year. You can make an argument that there is a swing trade here, going for the breakout towards 650, 660, with a stop loss below this range right here, 582. So the risk reward is, I would say, equidistant right now. There is a trade. It's not the best trade in my opinion, but it is a trade. And this is how the risk reward setup would kind of look like. for the breakout expansion if that's a style of trading that you like. Personally, I'd be waiting for a little bit lower, but then again, we're not sure we're going to get that. Meta with earnings 29th of January in 2 short weeks. Microsoft coming up nicely, 2.56%, but we got rejected a little bit at the moving averages. Well, what were we going to do today, guys? Blast off 6%? Probably not. So we'll see what Microsoft can do over the next few days. The price action is key here, though, because we are into the legacy area of resistance of the past year. 435 down about 425 current levels. You can see how much it's been holding back the bulls. That being said, price action-wise, not too bad. Daily downtrend, yes, but look at the size of this move, bouncing nicely off the 200-day moving average, which is this big green line right there, and bouncing out of local support, 417 down to 412. The biggest area, of course, of support is 405 down to 300, or 390, excuse me, but we're not quite sure it's going to get there. We will see. If it gets down there, I'll buy more, but down here, not a bad opportunity to be playing Microsoft, either short puts below or possibly even some swing trade shares, call debit spreads, or whatever you like. You guys know me, I'm still in some call debit spreads, and a leap call option that we're currently up a decent little bit on right now. So that being said, very nice size bounce on Microsoft. Take a look top to bottom. This is a engulfing move of roughly 70%. Gives the bulls a great chance of resetting the daily uptrend, but they're not out of the woods, right? Need to get that daily uptrend going to reset the daily, put an end to this weekly consolidation, and try and go for a new net leg of weekly momentum higher. So Microsoft not looking too bad, but the job is not done. I will be a big fan of buying a little bit more Microsoft in the way that I prefer, which is short puts. If we have a little bit of a retest down here over the next few days, I'll be looking for some short puts, 415 down to roughly 410. Moving into Netflix now. Netflix also with a bounce on the day. They were coming into daily oversold conditions. Nice to see that they put a little bit of a bounce together. Tough to determine where the short-term price movements of Netflix are going to go. Tuesday, the 21st, they have earnings in just a few short days. So although we are in a big daily downtrend, one good session of earnings is going to make them move in a big way. Keep in mind, guys, the Netflix earnings, that's not Netflix. This is Netflix. So keep in mind, the Netflix earnings are going to move roughly, let's call it 7.5% is the expected move for next week. Fairly wide expected move. So we will see what happens, guys, right? A big 7% move. They're going to recapture all of this lost territory in one clean shot and would put an end to this weekly consolidation phase, which is just that, right? It is only looking for a weekly higher low for further possible trend continuation. If earnings are poorly received, well, 7.5% to the downside would put us right back down into the 750, 760 area, which I would be looking for a dip buy. That will be testing the 26 EMA. Short-term support down there could be a decent little swing trade opportunity. At that point in time, Netflix would definitely be big time daily oversold. So we'd like to go shopping there, as buying Netflix in or around the 26 weekly EMA has been a good proposition over the last 2 years of trade. Moving into NVIDIA now. So NVIDIA also not the worst day as a whole, actually a very quite good day, 3.4% to the upside. Similar to semiconductors though, guys. Trendless right now. You can argue that they had the daily uptrend, they flushed it. Now the bears are possibly looking for the lower high into lower low flush. But overall, guys, very muted price action over the last 3 months for NVIDIA, as they've only been improving their fundamentals and putting out fantastic guidance. So support below stays put at 130 down to about 125. If you do not have an NVIDIA position, I'm not opposed to writing some short puts below 130. Think 128 down to the low 120s. Decent buy the dip opportunity. The best one, though, is down here, 119 down to about 115. 200-day EMA is there, and a strong, arguably bigger level of support because the weekly 50 EMA is there as well. That has never been tested since the rally on NVIDIA started in 2023. So this area could be a very decent level, guys. That would be a top to bottom decline, 23%. And usually in the context of NVIDIA pullbacks, that's about how much they go. This one went 30 with the Japanese trade, but usually in the past few years, 25% is at most the amount that the bulls are able to pull back before they get a little bit more support. So NVIDIA looking very strong, but I'll remind you what we need to see. Need to see the new daily uptrend and need to break above 147 with a engulfing move on the weekly to reset the weekly uptrend, as we've been largely trendless for the past 3 months of trade. Moving into Tesla right now, give me another brief moment. Looking at the time, guys, I can't do it. Not going to get under an hour, but maybe an hour and a few minutes, right? So Tesla up about 8.04% today. Fantastic rally from the bulls. They really needed it, taking out the previous highs, 425. So now this was one of the 2 case scenarios. Either with today, where we're going to get the flush daily downtrend continuation into this level right here, or the bulls were able to save and put in a new daily uptrend. They obviously went with the latter. That's why I say I'm not in the business of predicting markets at all, guys. I just have trade setups either way. If you come down here, I have one style of trade setup. If we do the daily uptrend breakout, I have another trade style setup. And this time, since we do have the daily uptrend confirmation, now the trade style becomes writing short puts below the market down here because the bulls have recaptured, and we have now recaptured the support range as well, 408 down to about 378. That being said, with the new daily uptrend momentum, this is the end of weekly consolidation, and contrary to what some people are saying, the bulls never lost the weekly uptrend, guys. This has always been one big weekly uptrend. They tried to set the lower high into lower low, but no flush, equal low. So these are the weekly higher lows being set, looking for more weekly trend expansion. So I'm looking to write short puts under the market down here around 375, and I'm using the Tesla 2x leverage product to do that, which is roughly writing below $24, $23 area. It is a momentum trade, yes, not the best valuation for Tesla up here, but it is one style of trading, momentum trading as well. And if we're looking for the breakout, now we have the breakout. So if you're trying to do some Tesla longs, the trade setup is as follows. The longs are entered here because now we have the daily uptrend confirmation. The stops go below here because that invalidates the entire trade as a whole. And then your take profit levels are up here. So overall, not the worst trade setup, right? In terms of risk to reward, it's roughly a 1-to-1, so not the best setup as a whole. And that's if your target is to the all-time highs. Obviously, if you extend the target to a $500 range, it's going to be a little bit better of a risk to reward scenario. All that to say, guys, I do like Tesla, but I will be using short puts for my entry trade. I'm not trying to buy call options up here because they do have earnings coming up in Wednesday, January 29th. So for that reason, I will play the writing options game, and we'll see what happens after earnings for the rest. Moving on to Palantir right now, they were up 3.38%, but still in the context of this daily downtrend, as we know, clear as day, daily downtrend possibly looking for the lower high. But where is the lower high going to be? This is what we need to pay attention to. If they bounce all the way up here and they set the lower high there, well, that will be like a 70-80% retracement size, and it gives the bulls a great chance of resetting the uptrend. However, if the peak is here, and how do you know it's the peak again, guys? Watch the hourly time frame. If you lose the hourly time frame, that is synonymous with the daily move higher being finished, and then we are looking to protect these lows at 63 with such a weak bounce and below resistance. If we only bounce all the way here and roll over, high likelihood of retesting the lows or even going a little bit lower down to the $60 support range, which is down there. So Palantir, decent sized bounce, but similar to the rest of stocks, well, not all of them, but the indexes as well, right? A bounce is nice, but can you convert into a daily uptrend? That is what we need to pay special attention to. On the weekly, we're still trying to do the same thing, still trying to find the weekly higher lows for further trend continuation. We will see if this is enough, or in the event the MACD chooses to lose a little bit more and we consolidate a little bit more, we're probably heading down to 60, arguably 55, which would be a retest of the 26 EMA, something Palantir has done many times over the course of this rally so far. So I would not be too nervous. And that is also synonymous with the area that I would not mind, writing some short puts on Palantir. Therefore, 55 down to 50. Let's not get it twisted. The valuation, even at 50, 55, would still be crazy. But if we're looking for a momentum trade and possibly, peak sell-off for a culmination into a daily oversold condition, and 26 EMA could be a decent little buy the dip opportunity and go for a little bit of that bounce trade. Moving into SOFI right now, SOFI with a tremendous day, 7%. And I was saying yesterday that SOFI will be impacted by these bank earnings because SOFI is a bank as well, right? Fairly obvious. So moving on down, guys, SOFI with the engulfing move, equal highs, 100% engulfing retracement. This is the best case scenario for the bulls. Now they have a lot of space. Anything above 1362, we'll just be looking for a daily higher low to reset into a new daily uptrend. You move even higher, it's going to be even better to reset that daily uptrend, of course. But now they've created the ideal amount of space off the lows, so looking quite strong, back above the short-term moving averages as well. And your daily MACD after what? A month worth of consolidation, looks like the momentum is curling right now. So got to pay attention to that. Weekly, well, the MACD, where we're taking a look at the cross. So you have a mix of signals right now. The daily's pointing higher, but the weekly is also pointing a little bit weaker. Now, this chart doesn't have to flip entirely red. It can flip down, can stay green here on the MACD and just kind of roll over a little bit and then expand further. So until it actually starts crossing, you kind of have to take these things with a grain of salt, right? That being said, weekly downtrend is still in motion, but if they can reset the daily into an uptrend, it would be the end of weekly consolidation, and we'll be looking out to take out our recent highs pretty much, which is roughly the $16 range, right? Lower high into lower low. You see it better on the daily time frame. It's actually right around these guys right there, right? So if you take that out, looking not too bad, this would end some of the consolidation for SOFI, and the monthly setup would not be looking too bad for continuation, right? Breakout, using this last support area as some defense locations, possibly heading up to $18, $20 in 2025. I would definitely not be surprised with the momentum and the sheer investor renewed positive sentiment that the stock has right now. Looking quite good, guys. For some trades, if we're looking for some trades, possibly wait for the retest and the daily uptrend confirmation. Entry goes there. Stop loss goes here. Then you're targeting the higher end of expansion, $18 to $20 range type of concept, right? If you're more of an aggressive bull, some people are taking this trade right away, but it's also prudent to wait for confirmation. I myself will be just writing short puts under the most recent lows. And that is pretty much it for SOFI. A lot of the momentum stocks have been coming back as well, right? Some of the names like SOUN coming back a little bit today. It doesn't look like much. I mean, all these are kind of overvalued. So we have a nice bounce for the risk on trades right now. Bitcoin, the Russell, other things like that. Palantir, SOFI getting a bit of a bounce, right? But all in all, guys, these are in heavy consolidation mode. And I still do say, you know, when the stocks are trading so rich and when we've made such large moves on the monthly, you best not invest more than you're willing to lose, right? Daily downtrends are clear as day. So although SOUN can be interesting, you still got to take this one with a little bit of caution because they are trading at like 2027 price to sales. And the company is not going to be profitable till 2028. Keep that in mind when you're trading these ones. It's the same thing for the quantum computing stocks. They've bounced nicely with the overall market, guys. Just play the price action, play the momentum for what it is, set a stop loss, risk only what you're willing to lose. That is the best way that you can play some of these stocks because you know it better than me, guys. These stocks have no fundamentals. I don't need to tell you that, right? These are not fundamental trades to begin with. They are somewhat of a hope and dream that quantum computing will be profitable at scale, both commercially and possibly for other applications, which the industry consensus right now is not really the case much before 2030. So these projections that we're making for these companies are like 3, 4, 5 years away. I'm all about investing in companies early, guys, but we've priced in years and years and years of growth in just a very short amount of time. So play these companies, if you will, for the hype, for the momentum. I'm not against it. Just be cautious and only risk the amount of money that you're willing to lose. No more than that, right? So that's pretty much it for today's video, guys. We'll take a look at a few of these momentum stocks here and there, of course, right? I'll give you my ideas on them. Uber is looking very nice too, one of the trades. We'll take a look at this on Friday when we take a look at the portfolio rundown. But all in all, guys, a lot of the swing trades that I'm in right now are performing quite well. Uber is still one of my favorite bets for the entire market right now. I think the company's very cheap, tremendous network effects for the stock as a whole. And the valuation is really where it's at for this one. Even at $67, guys, you're looking at like a 1.15 peg for a company expanding EPS at 30% per year, which is now profitable and scaling free cash flow as well. Super solid company. Nothing bad to say about that one. We'll take a look at more stocks as we progress through the week, but that is pretty much it for today's video. Hopefully you guys enjoyed it. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Also consider subscribing to the channel if you're new. We do these every Monday to Friday after the close. So if these are something you like, consider subscribing and getting me so close to that 5,000 subscriber milestone, guys. Thank you guys so much. It's been such a pleasure to interact with each and every one of you, whether you're in the Discord or only in the comments section of the YouTube channel. I thank you so much for your feedback, your comments, your kind words, and everything in between. And lastly, guys, if you have any questions, of course, on my trading strategy, on the markets, on a stock, on an option, always feel free to leave it down below, and I'll always give you a fair, objective second opinion if you want it, not financial advice, of course. And in the event, guys, you want access to the private Discord to see all of my trades in real time. Here are all the trades since the inception of the Discord, the wheel trades, the call option trades, the call debit spreads, the put credit spreads, the leap call contracts, the earnings plays, which we're going to start to do a lot of. I have some earnings plays put forth for tomorrow on TSMC. If you want access to all of these trades in real time, Also to the private morning live streams that we do Monday through Friday for about 2 hours at the open. I trade live and answer all your guys' questions on your stocks, your options, everything in between. And if you're not able to attend in the live streams, they're all recorded. You can also ask me all your questions on stocks, options, long-term portfolios, real estate, all throughout the day in our chat rooms. I also share all of my watch lists and all of my chart layouts with all the technical analysis, all the annotations for all the earnings whenever I develop long-term, theses like this as well, the pros, the cons of the current markets. All these charts, all of these watch lists, I do share with my Discord members and a whole lot of other tiny little perks that I don't have really time to talk about right now, but that people tend to enjoy too. We have a portfolio tracker. I'll show you the portfolio tracker. If you're not able to take the trades in real time, now that we're over an hour, I'm not going to rush this one anymore. Portfolio tracker, my bad, guys. Can I get it up here real quick or what? Is it going to give me, it usually gives me this, this Excel link right away. Maybe I have to, let me just click on it. My bad, guys. I don't want to take up too much of your time right here. I don't want to I'll show you guys the portfolio tracker. But anyway, so this is what the portfolio tracker looks like, updated once every day. So you can keep a track of the running positions, even when I don't show my account every single day in the YouTube video. So you see here, open today. These are wheels, covered calls, assigned shares, lottery plays for earnings, etc. Calls, all the leaps are down here. So we have tons of things in the Discord, right? And I'm very transparent all the time. So if that's something that interests you guys, always feel free to, take a look at the link down below for the private trading group and the private Discord. People have found tremendous success both in their trades and also in my strategy and also the psychology that I do as well. Because I put out a few videos here in the private videos, a lot of strategies and psychology of trading that I do not put on YouTube as well. And people have found tremendous value from all aspects of the Discord. So lengthy presentation for the Discord this time, but if it's something that interests you, the link is always down below. And if not, well, I guess I'll see you back on the channel, guys. That's it for me. Take care. Have a good rest of your evening. Tomorrow, decently big day as well. Retail sales first thing in the morning and thereafter, well, at the same time, TSMC, UNH, Bank of America, and a host of other earnings. So we'll see what we get. And I hope you guys have a good day. Take care. Peace. Love you guys as always. See you later.